Welcome to Business with Louis, the show where we dive into the world of entrepreneurship and explore the concepts that drive success. I'm your host, Louis, and today we're going to talk about FOMO and investment decisions. If you've ever felt the pressure to invest in a hot new stock or jump on a trending business opportunity, you're not alone. FOMO, or fear of missing out, is a powerful force that can drive our investment decisions, often with unpredictable consequences. But what exactly is FOMO, and how does it impact our investment choices? Let's start with the basics. FOMO is a psychological phenomenon where we feel compelled to participate in an investment opportunity because we fear that others will profit from it without us. This fear can lead us to make impulsive decisions, often based on emotions rather than careful analysis. The concept of FOMO has been around for decades, but it's become increasingly relevant in today's fast-paced digital age. With social media platforms and online news outlets constantly bombarding us with information about the latest investment trends, it's easy to get caught up in the hype. But as any experienced investor will tell you, making informed investment decisions requires a disciplined approach that balances risk and reward. So how do we navigate the complex world of FOMO and investment decisions? One key principle is to understand the role of behavioral finance in shaping our investment choices. Behavioral finance is the study of how psychological and emotional factors influence our financial decision. By recognizing these biases, we can develop strategies to mitigate their impact and make more rational investment decisions. For example, the concept of loss aversion suggests that we tend to fear losses more than we value gains. This can lead us to hold on to losing investments for too long, hoping to recoup our losses rather than cutting our losses and moving on. By being aware of this bias, we can develop a more nuanced approach to risk management and make more informed decisions about when to buy or sell. Another important principle is diversification. By spreading our investments across different asset classes, we can reduce the impact of any single investment's performance and decrease the pressure from FOMO. This approach also helps us to manage risk more effectively, as a diversified portfolio is less vulnerable to market fluctuation. Let's look at some real-world examples that illustrate the power of FOMO in investment decisions. Consider the case of Bitcoin, which skyrocketed in value in 2017 before crashing in 2018. Many investors who jumped on the Bitcoin bandwagon during its peak were driven by FOMO, fearing that they would miss out on a lucrative opportunity. However, those who took a more cautious approach and invested in a diversified portfolio of assets were better equipped to weather the storm. Another example is the rise of IPOs in recent years. When a hot new company like Uber or Airbnb goes public, it can create a frenzy of interest among investors. But as we've seen time and time again, the hype surrounding an IPO can be short-lived, and investors who buy into the excitement without doing their due diligence may end up losing money. So, what practical advice can we offer to listeners who want to navigate the world of FOMO and investment decisions? First and foremost, it's essential to develop a disciplined investment approach that's based on thorough research and your long-term financial goals. This means setting clear investment objectives, assessing your risk tolerance, and creating a diversified portfolio that aligns with your goals. Second, stay informed but avoid making decisions based solely on news headlines or social media buzz. Tools like portfolio tracking apps and financial news aggregators can help you stay on top of your investments without succumbing to FOMO. It's also essential to set clear investment goals and risk tolerance, and to regularly review and adjust your investment strategy as needed. Third, cultivate a long-term perspective and avoid getting caught up in short-term market volatility. As the legendary investor Warren Buffett once said, "Price is what you pay. Value is what you get." By focusing on the underlying value of an investment, rather than its current price, you can make more informed decisions that align with your financial goals. Finally, it's crucial to recognize that FOMO is a natural part of the investment process, but it shouldn't drive our decision-making. By acknowledging this fear and taking a step back to assess our motivations, we can develop a more rational approach to investment decisions and avoid making costly mistakes. In conclusion, understanding FOMO and its impact on investment decisions is crucial for navigating today's complex financial markets. By recognizing the signs of FOMO and employing strategies to manage it, you can make more rational, profitable investment choices. Remember, every great investor started somewhere, and it's the journey of learning and adapting that makes all the difference. As you move forward in your own investment journey, keep in mind the importance of patience, discipline, and continuous learning. Stay up to date with market trends and developments, but avoid getting caught up in the hype. With a clear understanding of FOMO and its role in investment decisions, you'll be better equipped to make informed choices that align with your financial goals. If you have any questions or topics you'd like to discuss, please don't hesitate to reach out. Like, share, and subscribe. And remember, every great business starts with action. Make your next move count.